Why rebuilding supply chains means higher commodity prices. Flint West reporting. They talk about decoupling like it is a software update. Like you just unplug from China, reboot the system, and everything runs the same, only more secure. That is not how the physical world works. The global economy is not short of resources. It is short of processing power, the industrial kind. Let us start with the number that matters. China controls roughly 60 to 70% of rare earth mining, but more importantly, roughly 85 to 90% of global rare earth refining and processing. Not the rocks. The conversion of rocks into usable inputs. That is the choke point. Rare earths are spread across the planet: Australia, Africa, the Americas. But separating neodymium from dirt is not a spreadsheet exercise. It is chemically intensive, environmentally destructive, and politically inconvenient. China accepted those costs. The West outsourced them. That decision delivered 20 years of cheap electronics, cheap renewables, cheap industrial inputs. But it also created a single point of failure, and now geopolitics has discovered the bill. When China restricts exports, as it has repeatedly over the last decade, prices outside China do not rise marginally. They gap violently. During prior export controls, rare earth prices in non-Chinese markets traded at multiple times domestic Chinese prices. Not 10%, not 20%, multiples. Why? Because alternative refining capacity does not exist yet. Now zoom out. The United States, Europe, Japan, they have all made the same declaration. We are rebuilding supply chains. But rebuilding does not mean replacing one factory. It means rebuilding entire ecosystems. Mines, smelters, refineries, power generation, transport, skilled labor, environmental compliance, and all of it under tighter regulations, higher labor costs, and slower permitting timelines. That is not efficiency. That is redundancy by design. And redundancy is inflationary. Take copper, the backbone of electrification. Copper is not a green transition metal. It is a civilization metal. Electric vehicles use 2 to 4 times more copper than internal combustion vehicles. Renewable grids require massive copper-intensive transmission buildouts. Data centers and artificial intelligence infrastructure are copper-dense by default. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Meanwhile, global copper supply growth is constrained. New mines take 10 to 15 years to bring online. Ore grades are declining, permitting is slowing, capital costs are rising. Now add geopolitical diversification. If you are no longer sourcing from the cheapest global producer, if you are sourcing from the second best or third best jurisdiction for political reasons, your marginal cost curve shifts up. That is structural, not cyclical. Same story with lithium, graphite, nickel, cobalt. China processes roughly 60% of lithium, roughly 70% of cobalt, roughly 90% of graphite used in batteries. The West wants independence. Independence requires duplication. Duplication requires capital expenditure. Capital expenditure requires commodities. This is where the narrative breaks for most people. They assume decoupling is disinflationary. Fewer imports, less trade, lower growth. Wrong lens. Decoupling is cost inflationary. You are replacing a globally optimized system with a politically optimized one. That means higher environmental standards, higher labor costs, lower economies of scale, longer build timelines. You do not escape physics by changing flags. And this is not theoretical. Governments already admit it. Strategic minerals are being subsidized because they are not economically competitive at current prices. If they were cheap, subsidies would not be necessary. Subsidies are just delayed price discovery. Eventually, the market clears. And when it does, commodity prices reprice higher to reflect true environmental costs, true security costs, and true redundancy costs. This is why the cleanest positioning is not hero trades. It is baskets, broad commodity exposure, strategic materials, industrial metals, energy-linked inputs. You are not betting on scarcity. You are betting on higher embedded cost structures. On a world that willingly pays more to avoid dependence, on governments choosing resilience over efficiency, on supply chains rebuilt the hard way, not the cheap way. They want sovereignty. Copper, rare earths, and industrial commodities are how you pay for it. That is not a prediction. That is an invoice. That is the trade. And just so we are clear, this is not about guessing which metal spikes next week. This is about owning the inputs of deglobalization. If you do not want to play hero, you buy the baskets, broad exposure, structural thesis, time on your side. DBC, the Invesco DB Commodity Index Tracking Fund. PDBC, the Invesco Optimum Yield Diversified Commodity Strategy No K1 ETF. GSG, the iShares S&P GSCI Commodity Index Trust. REMEX, the VanEck Rare Earth and Strategic Metals ETF. GLTR, the Aberdeen Physical Precious Metals Basket Shares ETF. You are not trading headlines. You are positioning for a world that chose sovereignty over efficiency and does not get to haggle on the price. They wanted independence. This is what independence costs. Flint West, signing off.